Technical analysis is the study of charts in order to predict future asset price movements. A successful binary options trading strategy requires an in-depth understanding of technical analysis and the indicators that can be used to predict the future. Hi, my name is Reese Shapiro, and I am your binary options trading coach. Earlier in this video series, we learned the basic principles of technical analysis. We learned how to read candlestick charts and the concept of momentum. We discussed support and resistance levels. In this video, we'll discuss more advanced technical analysis concepts, such as moving averages, crossovers, relative price measures, and volatility measures. This is the 7th lesson in our series. If you missed any of our earlier lessons, I highly suggest that you go back and watch them in order. Even if you think you already know all the material we covered, I'm sure there'll be something in there that you'll learn that you didn't already know. And if this is your first time watching this video, I usually suggest that my students watch each video at least twice. The first time you watch the video, you'll probably miss something that you'll be able to catch on the second or even the third time that you watch the video. So watch the video, take some time to review your notes, and watch it again. Now, while we're talking about your notes, I suggest that you have a pen and paper handy so that you can write down some of the key concepts and questions that you might have during the video. I find taking notes helps me fully learn new concepts more quickly and thoroughly. You're getting a lot of new information through this video series, so please be patient with yourself and the learning process. Everyone learns at their own pace, and it's better to take your time to learn to trade well rather than rushing ahead without all the skills and knowledge that you need to succeed. Now, in this lesson, we're going to cover some advanced charting techniques. You'll remember from our prior video that the basis for technical analysis is the candlestick chart. So I'm going to assume that everybody's watched that video. We're all familiar with candlestick charts. We've used them even a little bit in our trading, so I'm not going to go over that in detail again. If you feel you need to brush up on your skills on candlestick charts, please go back and watch our earlier video. Now, in that earlier video, we talked about the concept of support and resistance. Now, support and resistance levels are very important levels when it comes to trading, because support and resistance levels can indicate a change in the momentum. If an asset is trending higher towards a resistance level, the momentum might change at that point and head back lower. And similarly, if an asset is trending lower towards a support level, that support level might indicate a change in the future trajectory of the asset. So it's important to be able to identify these levels of support and resistance. And we talked about these levels being around certain price levels sometimes, but not always round number prices as an example. There are some other important levels that you'll need to be aware of when it comes to support and resistance. And those levels are called moving averages. Now, what is a moving average? Well, a moving average is a plot of the average level of the asset over a given number of prior periods. For example, at any point in time, the 20-period moving average is the average of the price of the asset over the previous 20 periods. Now, there's no magic to the number 20. You can use any number you want. You can use 20, 30, heck, you can use 22 days if you want. But some of the more commonly used moving averages are 20 periods, 50 periods, and 200 periods. And what is a period? Well, a period can be a day, an hour, a minute, or basically any way you want to divide up the trading time. Usually, for a short-term trading strategy like binary options, I'll look at a short-term period like 5 minutes or even 1 minute. So the 20-period moving average will be the average of the asset over the last 20 5-minute periods. And that'll go back around 100 minutes, or about an hour and 40 minutes. So 20 times 5-minute periods is 100 minutes. Now in this chart, each rectangle represents the periods over which the average is taken. So for example, for point 1, which will usually be plotted at the number 20, that'll be an average of the level of the asset over the previous 20 periods. Point 2 will be an average of the level over the previous 20 periods from there, so periods 2 through 21. And point 3 will be an average of the periods 3 through 22. So that average at any point is just an average of the prior 20 periods. When we look at a plot of a moving average, points 1 through 20 are blank. Why? Because on period 19, I won't have 20 points over which to average. Usually we can look back and get the prior 20 periods at any point in time, unless an asset, for example, is new to trading. Now, the reason why we use moving averages is to try to smooth out the level of an asset. We want to try to get rid of those little bumps and wiggles and focus on the overall trend. So here's an example that I think will be helpful. In this example, the asset is in a downtrend. So we're coming into a downtrend. You can see the asset trending down. And this blue line is the 20-period moving average. So two important things to point out about the moving average. One is that the moving average has a negative slope initially. So as we're coming in, that moving average is sloping downward. Another thing to point out is that for the most part, the level of the asset itself is below that moving average. There are points where it ticks above, but for the most part, it's below the level of the moving average. And those are two characteristics that are very common in a downtrend. But the question that we're always trying to answer is, will this downtrend continue, or when will it turn around and the asset will start moving higher? Because we want to know what's a good entry point for binary puts, where our investment thesis is that the asset is going lower, and where's a good entry point for binary calls, where we might think that that asset is going to turn around and go higher. So we're looking for an indication that that asset might change direction. When an asset is trending downward, as in the left side of the screen, that moving average line acts as a resistance level. So when the asset price bumps up against that resistance, it's going to head back down. And you can see that sort of here again, and here it comes close to that resistance level. In here it breaks out a little bit above, but for the most part bounces down below that resistance level. And again here. So each of these points would have been a potential entry for binary puts, taking the view that that asset is going to bounce off of that resistance level and head down lower. But now we're looking for an indication that that asset is going to turn around and head higher. And that indication comes right here, when the asset actually breaks out above that moving average, and it breaks out strongly. And that's an indication that our trend might be about to reverse. Now, often when a trend looks like it's about to reverse, you want to look for that moving average to turn around and that slope to turn from negative or downward sloping to positive or upward sloping. And that happens right here. With the asset bouncing off of that support level, you see that now the moving average starts sloping higher. The asset price is largely above that moving average, and that moving average is acting as support. Again here, and again in here. Now each of these points where the asset bounces off of that support level could be an entry for binary call options with an investment thesis that that asset is now headed higher. Now, moving averages are interesting by themselves, and they can give you lots of insight into these support and resistance levels as well as trends. But we can take this even one step more and combine multiple moving averages together. And this is called a moving average crossover. A moving average crossover is when one moving average crosses another, just like it sounds. So we'll use two moving averages, usually the 20 period and the 50 period moving average. You could also use either of those compared to the 200 period moving average. And you're looking for situations where the moving averages will cross each other. So the best way to show this is by example. So an example of a moving average crossover occurs right here. Again, the blue line is the 20 period moving average, and the yellow line is the 50 period moving average. So here you see that we have a downtrend. Both the 20 period and the 50 period moving averages are downward sloping, and the asset price is below both averages. But here, and we're looking at around the same point as we were looking at on the previous example. So here's that point where we had the indication that the asset was going to turn around and go higher based on the asset crossing the 20-period moving average. Now here we have the 20-period moving average crossing over the 50-period moving average. So if you were looking for confirmation that that upward trend is here to stay, this is your confirmation right here, the 20-period crossing over the 50-period. That's another potential entry point for binary calls because it's a bullish signal. And if you look at the chart, the asset does indeed continue to go higher as indicated here. So using a moving average crossover can help you to confirm a momentum change. Now, there's an indicator that I want to tell you about called a moving average convergence divergence, or MACD. And an MACD is calculated like this. We take a 12-period moving average and we subtract from that the 26-period moving average. Now, when the MACD is greater than 0, that means that we're in a positive trend because the short term, the 12-period moving average, is higher than the 26-period or the long-term moving average. And similarly, when MACD is less than 0, we're in a negative trend. Because term is going to be below the longer term moving average. Now, if that wasn't complicated enough, we then take a 9-period moving average of the MACD, yeah, that's right, and we call that a signal line. And when MACD crosses the signal line, that becomes your indicator to enter trades. Now, if this sounds really complicated, don't worry, just hold on. I'm going to show you an example. It'll be really simple. So here's an example. And MACD is usually plotted on its own chart because it uses a different y-axis than the asset level. So here we have a chart of MACD. And if your screen monitor isn't showing this up really well, let me just help you out a little bit. This light blue is the MACD, and the white is the moving average of the MACD. So that's our signal line. And I'm looking at this one particular point right here, where the blue line was below the white line, but it crosses above. And that's the type of indicator that we look for a bullish signal, so we're going to buy binary calls. Now, I drew this blue vertical line in to help you see where exactly that happened with the asset price. Because right here, what happened is we saw that crossover, and what happened? The asset trended higher. That's a bullish indicator, so if we bought binary calls here, we would have made money. So that's MACD. Let's talk about another indicator called Bollinger Bands. Now, Bollinger Bands is a technical indicator that was developed by a guy named John Bollinger, that's why they're called Bollinger Bands, in about the 1980s. And he was trying to quantify relative high and low levels of assets so that he could buy at relatively low levels and sell at relatively high levels. And he found that just looking at price charts didn't give him enough insight. So he developed this indicator based on price level and local volatility. And he did this by drawing 3 lines or bands. The middle band is a moving average, usually a 20-day or a 20-period moving average. And the upper and lower bands are drawn so that the distance between them is 2 standard deviations typically. You could use any, but the standard is to use the number 2 standard deviations. So what does this mean? Well, in periods of low volatility, the bands will be really tight around that asset price. And in periods of higher volatility, the bands will spread wider to give the asset some wiggle room. Now, the easiest way to use Bollinger Bands for trading is like this. Say you have an asset which is trading along. We see the graph of the asset price in the middle. And right here are the upper and the lower Bollinger Bands. Situations like this where it's close to the top band are an indication that the asset might be ready for a change in momentum, and therefore that would be an entry point for binary puts. And similarly, when the asset approaches the bottom band, that's potentially a bullish signal and an entry point for binary calls. So here you have the asset touching or above the upper band, so buy the puts, touching the lower band, so buy the calls, touching the upper band, so buy the puts. And that's for a good situation where the asset is range bound, meaning that the bands are relatively flat along here. You don't see a lot of movement in the absolute level of the bands. It's a more challenging trading strategy when the bands are sloping. When the bands are sloping, you can still use Bollinger Bands, but you need to combine Bollinger Bands with a price momentum strategy. And here's how you do that. Now, in a momentum strategy, you have a situation where the asset is heading in a certain direction. So in this example, the asset is heading downwards strongly, and it goes through that lower Bollinger Band. Now, if you were simply using a range-bound strategy, that would be a bullish signal to enter a binary call. But here, we're actually waiting for a change in that momentum. So we see the asset bottom out, and we see it start to rally, but what we're specifically looking for here is for it to head through and break through to the upside of that middle band. So the middle band, it's not in here, but it's, somewhere around, say, here. So you can see that when the asset breaks through that middle band, that's a bullish signal because that momentum, that downward momentum has ended and it's got positive momentum. And now you're looking for the asset to continue higher, potentially as high as that upper Bollinger Band there. So to use binary options to trade this type of situation, I would generally either buy regular digital binary calls, or I would buy a one-touch or a touch binary option with a strike price somewhere in here below that upper band. Now, some of these more advanced strategies you might want to save for when you have experience trading the fundamental principles of digital options, but they can be really cool when you find just the right situation to use them. So that's Bollinger Bands, and that's how you trade them in both range-bound and momentum markets. The Relative Strength Index, otherwise known as RSI, is another indicator that's going to try to help you find when asset prices are high or low. It's an indication of relative prices. And specifically, it tries to quantify overbought and oversold conditions. Now, overbought conditions mean that the asset might be ready for a reversal. In other words, if it's overbought, it's too high, and it might be heading downward. And similarly, oversold means that it's too low on a relative basis and it might be poised for an increase in prices. RSI indicator ranges from 0 to 100, and anything over 70 is considered overbought, and similarly, anything under 30 is considered oversold. RSI is typically on its own graph, and here's an example. We've got the asset on the top and RSI on the bottom. And I've drawn in this blue line here just to show you exactly where that level of 70 is, because you can see that in this range, the RSI indicator was over 70. And remember, we said anything over 70 is an indication that it's overbought, meaning it's ready for a change in momentum, it's ready to decline. Now, I will typically use RSI combined with some sort of support or resistance, some other measure of momentum, because I find that assets can be overbought or oversold for a while before they turn around. You really need a support or resistance or a momentum catalyst to really reverse that momentum. So when you have an asset that's an overbought or oversold condition like this, you want to look for some other indicators like a moving average crossover or a simple support or resistance level to indicate when that turnaround is about to happen. So, for example, right here, the asset was over 70. So if I draw this line straight up to the asset price, you see that it looked overbought for a while. But it didn't start to head down until sometime later, a few periods later. So I might look at that and say, okay, this asset's overbought. Now I'm going to look for some sort of an indication that that momentum is about to turn around. So that's RSI. Average true range is another indicator that I use, and ATR I use more as a measure of an asset's volatility. So I use this one the most when I'm trading range binary options, because range binary options depend a lot on the volatility of the underlying asset. So ATR, average true range, looks at the true range indicator, and the true range indicator is the biggest of these three things. Today's high minus yesterday's close minus today's low, and today's high minus today's low. So basically what ATR is looking at is the variability in the asset over a one-day period. If I include just that one price at the close yesterday in the one-day period, how much range is there in the price of that asset within one day? That's sort of the essence of what it's trying to get at. And so each day there'll be a value of the true range indicator, and the average true range is just a moving average of that true range indicator over some time period. Typically it's 14 trading days, but it can really be any number of days. Now, like I said, I like to use this one mostly for range trades, because for range trades, I'm really concerned about the volatility of the underlying asset. The more volatile an asset, the more likely it is to trade out of a range. So when I'm looking at doing a range binary option, what I'll usually do is I'll look at that ATR value and see where it is relative to where it's been in the recent past. If I'm placing a range in trade where I need my asset to stay within that range, I want ATR to be low. And if my trading thesis needs a range out option, so I want that asset to trade outside of the range, then I'm going to want ATR to be high. So now we've gone over using advanced charting techniques to find and use moving averages, moving average crossovers, Bollinger Bands, relative strength index, and average true range. You can use these indicators to develop or add to your investment thesis when you're trading all different types of binary options. So if you have any questions, you can send them to us at any time. We'll be happy to help you fine-tune your trading abilities and make sure you succeed. Now, before I end this video, I'm going to go over a question that I often get from my students so that you can all benefit from the answer. So a lot of my students ask me what to do if technical indicators are not lining up. So you might have a moving average crossover, which indicates a potential movement in one direction, with a relative strength index indicating a move in the other direction. You might have 2 or 3 indicators that agree, but another that's in opposition. So in that type of case, you really have to go with the highest probability situation. Technical analysis is kind of an art in addition to the science, because there are so many different indicators and you need to figure out what's the most likely thing that's going to happen. And if you have too many contradictions where you just can't figure out what's going to happen, just stay out of the market until something shapes up that looks good. You don't have to trade every situation all the time. Sometimes I find when I'm looking at technical indicators, I just keep an eye on them, continue to watch, and sooner or later something will come up that looks great for trading. You don't have to trade all the time. You only want to trade when things look high probability. So that's it for this lesson. If this is your first time through this video, I suggest you watch it at least one more time to make sure you have a handle on everything we talked about today, because we covered a lot, we really did. If you missed any of our earlier videos, I suggest you go back and watch those videos at least once. And in our next and final video, we'll learn some advanced binary options trading strategies. This next lesson will really help you in your trading. For now, I'm Reese Shapiro, your binary options trading coach, and I'll see you next time.